Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. I appreciate you taking the time to watch this video. It's actually an additional set of comments that kind of dovetail off of comments that Jeff and I made here a couple of days ago. So I'm sitting here on the afternoon of Thursday, March 12th. We've got another pronounced day of volatility in the markets, and just wanted to kind of give you some additional market and economic perspective, less so on the financial planning side, but just some things that we're watching, kind of our general observations about what's going on, and kind of some things to help set expectations here over the next perhaps 1, 3, and 6 months, at least from what we can tell right now. So right now, obviously, great volatility, and nothing more you can really say about that. It's just a fear, level of fear that I haven't seen before. Now, the one thing I want to compare and contrast against 2008, that was a financial crisis. This is not that. This has much more to do with fears over the economy, although it didn't start that way. I mean, this whole market turbulence as we kind of hit that midpoint in February was driven by supply chain concerns for companies that were doing business with entities in China or had operations in China, the back and forth, the trade issues that would be impacted by some of the disruptions in operations for Chinese companies. Well, that kind of bled into, as we began to see more incidences of the virus and the infections taking place across the globe, that it became real long before it was a pandemic. Obviously, there was a fear that got infused in the markets. The markets don't like uncertainty, and so the fear began to really become pervasive, and then it's just taken hold as we've seen lots of disruptions and activities, and the cessation of sports leagues and travel bans abroad and those types of things. So we're concerned about the coronavirus, and obviously there's a distinct health risk that needs to be respected, but I'm probably more concerned with the fear that's associated with it, the precautions and things like that, and what that's going to do to the consumer. The consumer represents 70% of the economy, more or less. And the consumer has been very strong. There's a lot of data to support that. Wages are up 3%, unemployment's low, job market is strong, household balance sheets are strong. Last month, we added 273,000 jobs, which is 100,000 more than expected. And we had noticeable revisions upward to prior releases, which is very important. So the 3-month average job gain is now the best since the spring of 2018. And unemployment is, the unemployment rate still at a multi-decade low of about 3.5%. So the labor market's on solid footing, consumers on solid footing, but what is the fear that precipitates from this coronavirus going to do to spending habits and things like that? We know that leisure activities and entertainment constitutes about 10% of spending, actually 10% of the overall economy. So obviously, if you're closing movie theaters, you can't go to sporting events and things like that. That's going to be impacted. We know that from the corporate sector, there's going to be concerns with cash flow. There's going to be disruptions there. Lower quality firms are inherently going to struggle. Again, going back to what I said earlier, this is not a credit crunch problem. So banks are very liquid. Banks have great capital retention, meaning that their balance sheets are strong. I mean, that was certainly not the case in 2008. So the ability for firms to obtain trade credit to help them manage through this, I think, is there. I think the ability for stronger companies to weather or absorb lower sales and lower earnings and higher costs for a period of time, I think, is there. But the lower quality companies are certainly going to struggle, and certainly in the energy sector, where they're dealing with lower prices now, and that's probably going to persist for some time as Russia is really trying to take advantage of the situation to help maybe drive out or at least hurt the shale producers producers here in the U.S. So I think we're going to see some concern begin to bear itself out in some of the corporate releases that we're going to have over the coming weeks as companies announce their first quarter earnings and kind of give projections on what they see in the marketplace. In fact, we'll probably see some pre-announcements prior to the actual release of data, which will probably evidence their increasing concern over the impact of the coronavirus on their own business. So market, I think, largely is already pricing that in. And I think the market's also pricing in the notion of a global recession and pricing in the notion of a domestic recession. And I think, the odds of a recession here in the U.S. have certainly picked up just because of, the potential impact on the consumer. I wouldn't say that it's imminent, but it's obviously something that we're going to monitor. But a couple other things I just wanted to mention. Obviously, what was in the news last week is the Federal Reserve came in and reduced short-term interest rates by a half a percentage point. And in fact, it was the first emergency action that they've taken since October of 2008, which was right in the heart of the financial crisis. So a very kind of a provocative move by the Fed to try to inject some liquidity into the market. And, it had a very brief and mild impact, but the selling ensued. But I think one thing that's really important to mention here is that, they've done some other things, which I won't go into in terms of explanation because they're kind of technical, but all told, the Fed has kind of promised almost $2 trillion of liquidity into the market. And we've seen the similar kinds of actions happen on the part of central banks around the world to try to provide ample liquidity for companies to make sure that operations continue and that economies continue to move ahead. So that's a very important distinction because back in 2008 there was a great fear that that wasn't going to happen and that couldn't happen, and that there was inabilities to meet the issues at hand. And I think the ability to meet issues at hand this time, at least from a financial market standpoint, are fairly strong. We do know that the medical community is racing ahead to try to find a vaccine for this. I'm encouraged by some of the comments with regard to fast tracking clinical trials and things like that. So I think as we get a little bit more visibility there, that should begin to drive more encouragement into the market. But the other things I just say, we need to let the volatility settle out. There's just such an extreme attitude going on right now that we need to flush that out of our system. We need to flush out the negativity, flush out to the point where sellers can no longer sell, and the buyers are beginning to, are beginning to anticipate a bottoming out. But I would say that bottoming out is really less of an event more so than it is a process, because we came into the year and we were really, the market was ahead of itself and it was really overdue for a correction. But I think in the short term, fixed income balances will provide a ballast against equity market volatility. When we do see that rebound and that bottoming out process, I think we'll see both U.S. stocks outperform, as well as especially high quality U.S. stocks outperform international stocks. Still stay relatively short on our average maturity on the fixed income side to kind of guard against some price risk. But I think that type of a portfolio will really begin to take root several months down the road as we get through the kind of this weakness that we expect in some of the pronouncements by companies when they announce their first quarter earnings, which I actually think will be pretty good, but the second quarter earnings will be down with the impact of the coronavirus and the fear driven therein. But then the market will begin to anticipate at some point in the future, perhaps several months out, when we begin to see a crest in the number of reported cases, when that begins to roll over, and we know that there'll be an economic pickup that comes behind that. And as we monitor that, the market will begin to anticipate that trend and that potential recovery of some of this lost activity that we've seen here as of late. And so when the market anticipates that recovery, we'll begin to see a lot more enthusiasm come back into the market, because as I said before, there's a lot of liquidity sitting on the side ready to help inflate those asset prices again. So what are we watching? Just in sum, consumer behavior. We're watching corporate earnings and pre-announcements and company announcements, and we're also watching the stabilization in the energy markets. I think those three things will give us increased visibility again in this whole process of bottoming out from this great state of fear that we're in. But in any case, it's just a little bit more detail for all of you from my perspective and what we're watching. We're welcome to take your questions at any time. Appreciate all your feedback. Appreciate all your questions. And I know that there's a lot of concern out there, but we have seen market volatility of this type of nature before, and things cannot go in one straight direction forever. So we do expect the sentiment to evolve and change, and I believe that we're prepared for the next phase. So thank you again for watching. I hope you have a wonderful afternoon, and please feel free to contact us at any time. Thank you.